Hi, this is Jean. I have a weekly, it's called a Realtor Roundtable networking group that I do with fellow colleagues in the real estate industry who are top producers and very active. And we had an insurance panel this morning, and I thought it would be helpful to share that information with other people out there. So hope you enjoy.
Well, good morning, everyone, and good morning, Paul and Sterling. Thank you for joining us. So when Jean asked me to help organize this panel, I actually interviewed five insurance brokers. Some of them I've worked with in the past, and some of them that came highly recommended from other brokers, from other real estate agents and brokers. So I finally decided to just keep it to Paul and Sterling only because of their vast experiences, um, which can be very helpful for us to navigate this market, and also because they have a very positive attitude. Some of the insurance brokers that I talked to over these last 4 weeks, they were downright depressed. Um, Especially the ones that were, I guess, captive is the right word, where their business is changing greatly. So I asked Paul and Sterling to join us, and they will introduce themselves as well. So I want to set a little bit of context on why this is important for insurance agents before we go there. So I believe when years ago, when I was doing buy-sell real estate transactions, I was leaving insurance to the buyers so that they can pick their own insurance agent, and I didn't have to be involved at all. But as you know, most of the loans for homeowners, for conventional loans, the loan qualification is based on PITI. So that's principal, interest, property tax, and insurance. And if the insurance dollar amount is way off, that could jeopardize the loan in the closing. And so if we're doing a 30-day rate lock, if we have a 30-day rate lock and we're not able to get a good quote from the insurance, then that could create a big problem. So this is why I believe insurance agents need to be proactive now in connecting the buyers with seasoned insurance brokers, and then in getting a solid insurance quote to the lenders as soon as possible. So with that, I want to ask Paul to introduce yourself first, and then Sterling next. And then for each of you, if you would talk about your years of experience, and then do a little comparison for the real estate agents here on your carriers or your portfolio of carriers, let's say 5 years ago versus now. And then if you have any niche or hard place policies that you carry that you want the agents to know about. And most of the agents here are, I would say almost all of the insurance agents here are focused on residential. So Paul, if you would.
Okay. Good morning. I'm Paul Nadler. I've only been doing this for 47 years. I'm a third generation insurance agent. I'm an independent agent. When things were good, we probably had a dozen markets that we could write home insurance with. Today, we have 4 or 5, depending on what the situation is. So we can write with Mercury today, Travelers, Safeco, CSE, and then we use some specialty markets if it happens to be a brush situation, and the standard markets are turning it down. And then, of course, the last resort, California Fair Plan. So we write both personal and commercial. Grandpa started in San Francisco in 1927. And so I've been doing this since 76. My son, who is 37, has been here for 13 years. I have 10 employees, and we're in San Carlos. So you should be able to get a hold of us to get a quotation for you quickly. I get realtors will send me an email and say, Paul, I listed this house. Can you insure it? So I can give them the preliminary idea. Yes, the house is insurable with a standard market, or it's got to go to the tougher marketplace. What else would you like to know? So as you guys are probably all aware, the toughest homes to insure today have knob and tube. They still have galvanized plumbing. They have wood shake roofs. So typically those homes have to go to California Fair Plan. And we as agents need photos of the home. Fair Plan to do an application, they want a photo, a close-up of the house number, a close-up of the front of the house, the rear of the house, and if they get a roof shot. So Fair Plan now is doing $225 billion in insurance in the state of California. So because the marketplace has got so tough. And what Elsie was saying is captive agents, State Farm, Farmers, Allstate, those guys are not writing new business these days. Farmers, I understand, is writing 7,000 policies statewide for the whole state. So if you have an escrow closing towards the end of the month, you're probably not going to get a farmer's quote. If you can get into Farmers, you need to get it in the first, say 10 days of the month before they run out of capacity for the month.
So Sterling, would you introduce yourself as well?
Absolutely. So good morning, everyone. And my name is Sterling Fairholm. I own Reliance Insurance Brokers and San Jose Insurance Agency. Got office in Pleasant Hill and in Campbell. I've been in the business for about 15 years, hoping to pass it on generationally like Paul has gotten to do, but my little ones are too small for that now, but it's a great situation. I mean, number of carriers 5 years ago versus now, really we should be talking about number of carriers a year ago versus now. A year ago, this time is really when things started to deteriorate. Not really. I mean, 5 years ago, and even a year ago, probably had 27 home markets realistically, from preferred vendors all the way through the secondary market. And to echo what Paul said, we are writing those same carriers. There's a few very niche markets that are still available, but it is absolutely a case-by-case situation. So there's some niche markets right now that are beyond the normal preferred markets that Paul had mentioned, and they will do up to $1.5 million in reconstruction. So when we're looking at a property, we're paying attention to what the recon is, not necessarily what the value of the property is, because we don't care so much about the land value as much as we want to make sure they can rebuild. And that's kind of what we're paying the most attention to. California Fair Plan is absolutely just it's the insurance company last resort, but it comes first and foremost for a lot of people at this point, and it's not ideal. We're not trying to go there. We don't want to, but they have extended their time frame as far as their underwriting. So I guess the question of where was it 5 years ago versus now, it's very different. It changes weekly. Whereas advertisements from insurance companies, I used to gloss over. Now I look because I'm worried that they may tell me they're not going to accept new business come starting on Friday, or the sales reps that come into our offices. I have them preemptively tell us when we're trying to schedule a meeting that it's not bad news. They're not closing. They're not walking away. We're trying to take really good care of what's coming for people, what options are available. So we've had some success with properties over 1.5 million or over 3 million in reality, because 3 million is the cap with Cal Fair Plan. There's a few very, very high net worth markets that are available still. Rush is acceptable. It's just very expensive. And so we have to kind of keep that in mind when we're bringing it up and having these preliminary conversations with realtors, with mortgage brokers, as far as getting into contract. I have people reaching out before they make an offer, which is also a great idea, but the market changes daily. And so I think now it's communication more than anything else, just trying to make sure we know exactly what people are looking at, what the market's going to be at that time, and then what the condition of the property would dictate of what markets are going to be available. Type of roof, obviously a big deal. Those same things, the knob and tube wiring and galvanized plumbing, all a big deal. So we're kind of pre-underwriting things a lot differently than we did this time a year ago.
So Paul and Sterling, thank you for your introduction. Earlier, Paul, you mentioned some of the issues that some of the red flags that would cause issues in getting coverage. So we heard wood shake roofs, we heard knob and tube, I've heard bars on windows. I've heard brush fire areas. Is there anything else that the agents on the peninsula should be aware of?
So the main thing, carriers today, because of the internet, they use a lot of technology and they can zoom in on homes from above and look and see the housekeeping. Is the roof in good shape? Are there old cars sitting in the front yard? Is the backyard full of debris? Are there trees hanging over roofs? So housekeeping is very important today in the pre-underwriting. Any insurance company, once they even write a policy by California law, they can get off in the first 60 days if they find out it isn't what they thought it is.
Sterling, do you have anything you want to add to that?
Yeah, so some of the beyond those things, which are all obviously really important, the occupancy type has started to become a real issue as well. So knowing what how the property is going to be occupied, whether it's primary, secondary, full-time rental, and nowadays what's caused bigger issue is the short-term rental Airbnb exposures. Even in areas that aren't a fire risk, those items matter tremendously. The markets for full-time rentals have shrunk drastically, where now carriers want you to bind with a carrier that has their auto, their home to go with the rental. They won't let standalone rental. Safeco, which for my entire career has always been the place to go with rental properties, you now have to have your home and auto with them to write a rental property. Things like that are shifting the way it's looked at. And the short-term rental, which is newer, obviously something that's been dealt with, but with the Airbnb and VRBOs, that is a different exposure. It's a different risk. It's looked at differently. There's very specific questions with carriers that ask, will this be, when you're looking at a landlord, will this be occupied less than X, Y, and Z, depending on the carrier? And that shifts that because it's an automatic decline with many markets. And right now there's very limited markets for short-term rentals, especially on a full standalone policy without the Cal Fair plan. So we're running into that as an issue. So those are things besides the condition of the house that we need to be paying attention to. The year of the roof versus what type of roof it is now matters. There's certain carriers that put conditions of 20 years or more, they won't write. Even on a composition shingle roof that has, 30, 50-year life expectancy. So there's beyond just the normal conditions, there's other factors that we have to pay attention to.
Okay, so we've all heard about California Fair Plan. And I've actually, as a lender, as a hard money lender, I'm seeing some of these, many of these, our clients getting California Fair Plan. But I don't actually know how it works. And why there is a California Fair Plan and then very often a supplemental or a gap plan.
Sure.
And the issues or the I guess the issues that people are anticipating with a fair plan. So if you two would please talk about that as well.
Yeah, sure. So the California Fair Plan's been around for a long time. This time 8 years ago, we would maybe do one a year. It was something you didn't really utilize unless it was in the middle of the forest and it was tremendously bad conditions, because there was plenty of companies that were doing those properties. Even when you went to Lloyd's of London, it was a better option than the Fair Plan. And it is known as the insurance company of last resort. If you think about Florida, Florida has something similar called Citizens because they deal with the hurricane, and normal insurance doesn't want to deal with that there. We have the same thing for fire, and it's called the Fair Plan. The reason there's two policies to create a normal home package is because the Fair Plan limits their coverage to specifically named perils. And those perils are going to be fire, lightning, smoke, wind, and vandalism. So in order to get a normal complete home package that would cover all the other items that everyone's worried about and the lenders require, because let's keep that in mind, that's what we're talking about. The lender needs certain items. So we're getting your water, your liability, your theft, everything related to completing that home package is a second policy. And that policy is called it's called a DIC, which stands for difference in conditions. Lenders will call it a wrap. Some people call it a supplemental policy. Some people call it a companion policy. but the true definition is called a DIC. And those two policies together create a full homeowners insurance package. To Paul's point, and I'll let him expand on it, there's a time frame to get the fair plan that revolves around photos and certain dollar amounts over 1.5 million versus under 1.5 million matters. But the fair plan is now a real part of the insurance market, not just an afterthought that we use for extreme risks.
Okay.
Paul?
All right. So California Fair Plan started in the 50s. Every insurance company that writes insurance in the state of California, the fire portion of it, has to belong to the Fair Plan. So right now, State Farm is the largest carrier. They have something like 9.8% of the fire market of California as a state. So they have to accept 9.8% of the risk of Fair Plan. And as I said earlier, Fair Plan now is all the way up to 225 billion. So basically, State Farm is on the hook, which they have no control of $22.5 billion of potential loss in California on the riskiest part of California. So different insurance companies have different percentage of that risk. That pool, all the carriers are forced to belong into the pool. The rate is set by the Fair Plan organization, which gets authority from the state Congress and Senate, and ultimately the governor. The insurance commissioner only has so much latitude. He's a figurehead, but it's basically the Senate and the Congress. The government just closed on Thursday of last week. They haven't done anything on helping us in California with insurance. So I suggest all of you complain to your congressmen and senators to get their act together and get this going, because now we got to wait till January, and we're probably going to be in a tough situation that we're in now for a couple of years, because nothing's going to get fixed overnight. All 49 states of the 50 states in the United States get to charge back reinsurance. Insurance companies do to their ratepayers. In California, we can't. The carriers can't charge us. So what is reinsurance? Insurance companies buy insurance on all their policies. So if they have a $50 million catastrophe loss or $100 million loss, they go to their insurance company. And so reinsurers are all over the world. We insure stuff in Europe. European companies reinsure our risks. So insurance is all spread out. In California, they are losing billions of dollars. And so I see, my crystal ball says rates are going to go up for the next couple of years. It's not going to get fixed overnight. And this is going to be a roller coaster ride.
Okay. So since the insurance rates are going to go up and the carrier, the market is still changing, I want us to get to some practical solutions and ideas on how the real estate agents here can protect their transaction, make sure it's a smooth transaction, and everybody walks away happy or happier. So I want to first invite everyone to raise their questions. And then while we're waiting for questions, I want to ask the first question is, I'm hearing from some of my borrowers that they're being asked to take photos of the property in order to get insurance. And one of my buyer for conventional, so this is a bridge loan, so it's a conventional home, fully renovated. She was complaining that she was spending more time taking photos of the house than the property inspector. So what exactly is going on there? And is this something that we real estate agents, listing agents can do to help?
So some insurance companies now are requiring the consumer to use that insurance company's app on their phone and go do a specific inspection of their home. They want to see, is the water heater strapped? What is the general housekeeping of the house, inside and out? And by getting the consumer to do it and giving the consumer like a week to get it done, it's quicker than get a third party inspector out there, and they can decide, do they want to stay on this risk or not.
And it has to be the consumer?
It depends on the carrier. Most carriers today are inspecting every single property that we send them. They'll do a drive-by, they'll do satellite. They'll look and find out if there's a trampoline in the backyard. I insured a duplex in Palo Alto for a customer bought as an investment. And from satellite photo, they saw that there was a trampoline in the backyard. And so I had to get the owner of the property to get the tenant to remove the trampoline. Otherwise, they were canceling the policy.
Wow.
There's other photos that could be requested too, besides the inspection, which would be the California Fair Plan photos. That comes up a lot, and one of the things I would say as realtors especially would be to preemptively take photos for in an area of high fire. So these are definitely areas that you think is a chance that it may have to do fair plan. Preemptively take photos so that when the buyer or the buyer's agent or someone comes through talking about it, that you're kind of aware of it, because they can't use the listing photos. The California Fair Plan looked at listing, they will reject the application if you use the listing photos. So under 1.5 million, quite easy. Just need a picture of the front of the house. If the address isn't on the front of the house, then we need a picture of wherever the address is. Mailbox, on a rock, on a curb. It doesn't necessarily matter. It just needs to be a photo of the front of the house and a photo of the address. Over 1.5 million, and that's of total coverage, not of just rebuild. So over 1.5 million, then you need all four sides of the house, same photo of the address, and you also need a couple photos of the roof. You don't actually have to climb up on the roof to take the photos, depending on what the situation is, just holding your phone in the air, zooming in on the roof from the front and the back the best you can. But those photos, I have a lot of conversations because we're doing a secondary home in Tahoe, or someone's, up and down the peninsula, Saratoga, Santa Cruz Hills, all these areas, they're pretty much the fair plan or bust. There's certain parts of these areas where there is no other option that's realistic, price point wise, as well as just availability. And so having those photos taken in advance, they say they have to be done within a week. Realistically, that we timestamp them at any time, as long as they just can't be old listing photos or current listing photos. They have to be different angles, different conditions than what's on the internet.
But they're not tracking, for example, whose phone is being used.
No,
okay.
I personally prefer to do it all myself. I've had some realtors send me the photos pre-timestamped, and the problem is it depends on when we're submitting it. So we take the photo and we actually timestamp and do exactly. I will crop certain things that I know that I want a better angle, or I want it zoomed in, things like that. So we just want a photo, and then we usually run with it from there with time stamping and making sure that Cal Fair gets it the way they want it. Because if you get rejected, you have to start over. And now with the 7-day turnaround, we're talking, and that's business days. We could be 2-3 weeks realistically to get the Cal Fair if we get rejected once. So that first submission needs to be perfect.
Exactly. Yes.
Okay. So one of the things that I heard Sterling, you say earlier, is the $1.5 million reconstruction cost.
Yes.
Very few homes. I think most homes are exceeding $1.5 million reconstruction cost now.
Well, it depends. Your 2,000 square foot home, that's at $500 a foot plus extended replacement. That's $1 million. So you're fine. When you start to get to the 4,000 square foot houses, 1.5 is not going to be enough, especially in our area where reconstruction numbers are, quite a bit higher. The first problem is getting someone to understand that reconstruction figures are where they really are. You really have to try hard to explain to some buyers or some homeowners, especially if they're getting dropped. I find it more about when they're getting dropped by their current insurance than I do when they are trying to buy a house. And the reason is they look at their current insurance from State Farm or someone, and it says $730,000 to rebuild. And I say, well, it's a 3,000 square foot home. There's no chance you can rebuild for 700,000. We're going to need to fix your coverage A to rebuild. And that conversation is almost harder than, what the options are. So 1.5, and the reason for that number is there's a few secondary markets, we'll call them that, but really realistically what they are is they're past the preferred, past the normal markets you see on TV. And they take a little bit higher risk. So if we're going to use a scale of 1 to 10, realistically right now, most carriers aren't doing past a 3. 4, 5, and 6s, sometimes you can get them with the secondary market, but those cap at 1.5 million. So if we try to submit something 4,000 square feet reconstruction of 2 million, it's an automatic rejection. So that's why that cutoff is there, is because it's their capacity numbers. And they're national companies. These are companies that aren't really always paying attention to what California recon is. In most states, it's not as big of a problem, but you're in California, especially in the Bay Area, that 3,000 square foot home could easily be 1.8, 1.9 million to rebuild. And that 1.5 million cutoff becomes a real problem here.
So then what do you do?
Well, that's where you go up to the next market. So it just kicks us out of those as options. The ones that are going to be over 1.5, then the Cal Fair plan caps at 3 million, for example. So now maybe we could do that moderate risk with a Heritage or a home site, Delos, something like that. We can no longer do that. We have to go to the fair plan because the brush risk and the reconstruction over 1.5.
Paul, do you have anything you want to add to that?
I agree with Sterling. It's the marketplace is very frustrating for us as insurance agents, as well as the consumers. It seems like every day is bad news. There is some place it's all, will the consumer pay the price? So to help control costs was one of your questions. Bundling, giving the same carrier your home and your auto and your personal umbrella. Most carriers today will discount each policy by 15% by having the secondary policy. So that's very important. Right now, our hands are tied with Safeco and Travelers. If we want to write home insurance, we have to write their auto. If their auto doesn't fit, then we can't write the home. If their home doesn't fit, we can't write the auto. So 6 months ago, we didn't have that restriction, but now we have that restriction.
So that also means that if I'm buying a home and I have a rate lock, I have a deadline, and if I have to swap my auto and let's say my homeowner's policy and my umbrella policy all to a different carrier at the same time, I need more time. My 30 days is not going to cut it.
It depends on the availability of information. I mean, if someone's is open to sharing, we can run auto and umbrella in an hour, a half an hour, maybe 15 minutes in some carriers if we have all the info. So besides the hassle, because honestly, the closing escrow of a home has all these other things. The last thing I want to talk about is moving their auto insurance in that situation. And to Paul's point, yes, I mean, the price matters too, but Mercury, which is one that is still actively writing, and you just cross your fingers. They have a bunch of blocks in their system, automatic blocks that say as soon as you quote it, it's a big red stop sign. That stop sign sometimes just goes away by clicking the auto discount. So it's even beyond the requirement of bundling. Sometimes it opens up a market for us that wouldn't be available, even though they don't require the auto.
Okay. So Dennis, if you are still there, I'm going to ask you and I ask you to jump in. So Dennis, as a hard money lender, I'm used to, let's say a year ago, I'm used to seeing insurance quotes for homeowners, like that's where the price per square foot for replacement cost is like $250. And then I would push back and say, no, it needs to be 300, it needs to be 350. And insurance agents would push back and say, no, that's too high. And I think what I just heard Sterling say $500 a square foot for replacement cost. So Dennis, in your world, how often do lenders or does Wells Fargo look at the replacement cost? And how carefully are they reviewing all this?
Yeah, that's a really good question. And I think your approach is actually right? We can spot what looks like not enough coverage and suggest, ask again. That, in my experience, doesn't look like enough to rebuild a property. But Wells Fargo's position is, and I think this is becoming more of the trend, we've been trusting the insurance agents to use their estimator forms and determine that there's enough, so long as the guaranteed replacement cost endorsement, or whatever it's called now, is part of the plan. So we aren't getting as granular as I would have thought we would have. I have worked with lenders who had in the past, and there was pushback, just like you said, from some agents where they would say, no, we determine it's enough. But Wells Fargo stays out of it at this point in time, so long as the professional determines that there's adequate coverage.
You said that that's a guaranteed replacement cost?
Right. There's a replacement cost endorsement. Perhaps Sterling or Paul, you can actually. I sold insurance in the 80s, so some of my verbiage is a bit outdated. But is it still called a guaranteed replacement cost endorsement, or what's it called now?
It's a replacement cost endorsement. Go ahead, Sterling.
I was just saying, guaranteed replacement cost isn't something in California. It's extended replacement is what we deal with. Extended replacement takes your coverage A and extends it by 25 or 50%, depending. Some carriers 200, that's pretty much gone at this point. But that extended replacement cost is what that you're looking for as a lender to be on there to kind of help with that gap between what maybe is on the policy versus what real reconstruction is. But going back to what we were talking about earlier, extended replacement is not available in all policies now. So the preferred markets, absolutely. But I mean, up till maybe it's been a year and a half, California Fair Plan didn't have extended replacement. So with some of the secondary markets, the Fair Plan, it's going to be replacement cost is the number that's on there. And getting a lender to accept a flip insurance policy is not hard. I mean, to be honest, you can just give them a document called a reconstruction cost estimator. And as long as that number is below the loan amount, they don't even care. So really, we need to be doing the right thing for the clients, not necessarily for what the lender requirements are, because the lender's not paying, just to Dennis's point, they're not paying enough attention to it. They just care that the loan amount's covered, and that's it.
And I'm curious about the policy deductibles. I mean, our guidelines say for most of our policies, excluding a few outliers, 5% of the policy limit is the limit for the maximum deductible we have. Are you seeing that there's much savings for consumers if they really jack up their deductibles? And has any lender pushed back with a lower deductible request than that?
I'm not finding pushback. We typically are doing 1,000 or 2,500. Unless it's a very high value home, there's not enough savings to warrant the higher deductible. Additional way to get savings are buying a newer home that has fire sprinklers, you get a discount. If you have a burglar alarm that rings at an alarm company, not one of these internet-based jobs, it's ringing at an ADT or somebody like that, you can get a discount for having an alarm, both burglar and fire, up to another 15% off the home price premium.
Using
Wow,
that
but
percentage,
$5,000, $10,000 deductibles not adequately moving the needle is what I'm hearing.
We can show the consumer in 2 minutes what the difference is between the different deductibles, but generally the savings is so small it doesn't warrant it. You'd have to not have any claims for 15 years, and the average consumer has a claim between 5 and 7 years. So if the break even isn't in the 5 to 7 years, it doesn't pay.
Thank you.
Sterling, did you want to add something to that?
Well, Paul hit it exactly right. That once you get past 5,000, it makes almost no difference. I mean, you would see a $70 difference on a policy from going from 5 to 10, and it just makes no sense to do that. But to what Dennis was talking about percentages, and I would warn everyone to pay attention to that as percentage deductibles. State Farm standard now is do a 1% or a 0.5% deductible, and first, the buyer doesn't typically understand what that means, so that's it's a little misleading. But typically, we don't suggest using a percentage. Use a fixed deductible, and the reason for that is because every year the policies go up with inflation protection, and some years is more than others. I mean, you could have a $12,000 change to reconstruction, which to a 1% deductible makes a very small amount. But sometimes we see $150,000 bump, which would all of a sudden raise your deductible significantly. And that unknown of not looking at something for 8 years, 10 years, and now all of a sudden that deductible that you thought was $2,200 is now $3,700. That savings we're talking about is not there to warrant a percentage deductible. You want to kind of fix the deductible, make sure you know exactly what it's going to be. And then as coverage inflates over time, it doesn't affect how your deductible is handled.
From the insurance perspective, does a PUD consider to be single family home or a townhome? We had confusing conversations with the insurer in the past because the property was marked as a townhome with the HOA and the prelim says PUD.
So planned unit development.
Yes.
So it would depend on the HOA policy. Is the HOA policy covering the structure, or is the HOA just covering all the public rounds? Because I've had them both ways, where the consumer has to insure their structure even they're in an HOA, versus the walls in on a condo policy. So that determines which way we go.
The CC&Rs will also, CC&Rs and bylaws will have a section in their own insurance that tells what the association is supposed to carry and what the buyer or the homeowner is supposed to carry. So typically when no one has any idea what the policy should be, an HO6 or an HO3, which is condo versus homeowners, we just have everyone get the HOA documents so we can look at them and tell you exactly what they cover. The difference between an HOA and a PUD doesn't necessarily dictate anything to do with the insurance. You can have a home in a HOA and that has nothing to do with what the insurance should be.
Robert, you have a question?
Yeah, quick question. So regarding the fires and then the fines or fees that PG&E may have had to pay regarding those fires, did that go to the state? Did some of that money go to insurance companies to help them? Did it go to consumers of insurance policies? I'm just kind of curious where that money may have went. I mean, not that like I'm saying a big scandal or anything. I'm just curious, did it go to the PUC? Did it go to some governmental entity? Did it go to people who were damaged and the victims? Or also, did it help out the insurance companies at all?
I understand some of the insurance companies did receive money from PG&E. How much and who got what, I don't know. But that's what I've read in the trade press.
Oh, great. That's good to know. Thank you. Money
actually also went to homeowners in some cases. There's a Paradise specifically. There's a bunch of stories of and also in the Napa, Sonoma, and Santa Rosa fires. Money did go to homeowners that exhausted their insurance. So insurance policies, especially in those environments, don't carry a long enough period of loss of use. And so there were some lawsuits about the fact that the insurance was exhausted and they still weren't able to get to the point they needed to be to rebuild their house and so on. So that I don't, again, same thing, no idea what numbers, how much people got and things of that nature, but some did trickle down to homeowners themselves.
And one more quick question. The way I understand it, and I might be using old information, is a lot of the some of the insurance premiums are invested in the market by the insurance companies. So when the market underperforms, then you can also anticipate insurance rates going up. Is there a connection there? Or maybe it's not that direct of a connection, but would a declining marketplace have an impact on rates of insurance?
I would say yes. It's also global warming is affecting rates, cost of construction's affecting rates, supply and demand of material. In auto claims now, cars are taking a lot longer because they can't get the parts to get the vehicle fixed. So that's all affecting the rates.
Actually, Robert, it's a really interesting question because you'd think an environment right now where interest rates and the returns on invested money is so much higher, especially in low risk investments like bonds and things of that nature. You'd think insurance would be doing better in this environment because they'd be reinvesting that money. The problem is that almost every insurance company is operating in the red. And so there isn't money to be invested in this market where they're getting the returns that they would be getting. So for the period of 10 years prior to this, with this kind of situation we're in now, the returns were very low. So rates would raise because returns weren't very good, which is one of the biggest things that insurance uses, that, you know, to keep their profitability in a good spot and how to make money. So in a market like this, where you'd expect them to be getting those returns and doing better and not needing rate, it's actually working the exact opposite.
Excellent. Thank you. One more quickie and I'll shut up. You brought up auto claims, and one of the things that I've understood is these electric vehicles, they're not as repairable as the older traditional cars. So insurance companies are taking a lot of auto losses where they're totaling cars that may have been repaired in the past. Have you experienced that?
I have on a couple of claims on Teslas where car was just bumped. It was $20,000 because there's all this electronics in the back of the car. So now some carriers are saying we won't insure a Tesla. I had a customer with a brand new $153,000 Porsche SUV on the San Mateo Bridge. She got rear-ended at 5 miles an hour after going round and round with the other carrier's insurance company. They totaled out the $153,000 car that was a week old. If you saw the pictures of it, you wouldn't think there's anything wrong with it, but it messed up so much electronics getting rear-ended that they totaled it.
So that's my excuse to stay with my Honda Accord. Right. So we have 3 more questions, one from Karen, and then Denise, and then Anne has a question on earthquake. And then I will invite our panelists to help us with some practical solutions and tips for real estate agents. So
And
Karen.
Lisa has one too. Did we cover that one?
Oh, sorry,
In the
Lisa.
chat.
Yes.
Yeah.
Okay, so 4.
Can I touch on Lisa's one? Because I think it'll be helpful for everyone.
Can you read it out just a bit?
Yeah, so it says if a listing is not in a high fire severity zone, but is in a supplemental fire zone, do you think that this is a red flag and will affect the ability to obtain insurance? What I would actually say to everyone here is, don't pay attention to the reports that you guys get. Don't pay attention to the what is it? I think there's a report that comes up.
NHD.
Yeah, the natural hazard report. Stop looking at it. It is the biggest waste of time when it comes to what insurance companies care about. I've had so many conversations where someone's like, well, the natural hazard report said it's not in an X, it's not in a this, it's not in that. Insurance doesn't use the same reports. And in fact, which is, you know, unfortunate, insurance doesn't even use the same report amongst insurance companies. They don't even use the same rating systems. One company might use a 1 to 10. One company might use a high, medium, low. One company, I mean, there's no baseline for this. And so looking at something and saying, is it a high severity zone, is just flat out nothing that matters to an insurance company. They are not paying attention to a supplemental fire zone. It is either a yes or a no. There's nothing we can show them that would tell them differently. And 9 out of 10 times, it's a computer system that is denying this based on the address. There isn't an override button. In most cases, there is an ability to refer it for extra review or show that, look, they've done a great job of clearing their land. So if I can make one suggestion, is take the natural hazard report as a absolute grain of salt and a helpful thing for maybe other items that are on there that are helpful, but from a fire standpoint, do not bother. It is not going to matter from an insurance standpoint anyway.
Great. Denise, your question?
Thanks so much. This is super helpful and sad at the same time. So my question, you said earlier about the houses, if they have a shake roof, if they have galvanized pipes, and there was one other thing that's, knob and tube. And so houses around here, that's super common. And so are you saying that you can't get a policy, or your policy is going to be expensive if you have all those factors in a property that you're considering purchasing?
it's going to make it more expensive and limit the market that will offer insurance for it.
Okay. All right. Interesting. Thank you.
Uh-huh.
The one thing that you should take away from, what this conversation and in general is, it's very rare that we're not going to be able to get insurance. I mean, I don't tell anyone there's no option very often. And it's usually I'm telling them, don't buy this house. It is, it is really, really beat up and you're going to have nothing but problems. It's not necessarily that there's not an insurance option. There's always going to be an option, but it's always with what price does that option come with?
And Sterling, they can always buy the house and then get a hard money loan from us.
Exactly.
And then we'll figure out how to complete the project.
It actually circles all the way back to what Paul said at the beginning of his introduction is it's not necessarily getting the policy that's the trouble. It's what happens after they see it. So knowing a property is in bad condition, you kind of have to know you're starting a 30 or 45 day timeline to fix things. And because it's going to happen. I mean, if we know that there's peeling paint and we know that, and the buyer's buying it knowing that this is the case, they just need to know that that inspection is going to happen. And that inspection is going to show there's these deficiencies, and insurance company is going to say, we're getting off of this in 30 days, 45 days, unless you can show that this is repaired. So it's a little bit of starting a timeline once you buy a house. And those are conversations you just want to openly have with the insurance professional.
Yeah. Karen, you have a question? Karen?
I asked, she had been unmuted. I muted her and then asked her to unmute now. So Karen, there we go.
So one of my escrow situations, we had a house that is about 50 years and older, and the insurance company required the home inspection, and also requested that the home inspector will write a note that all major items of the house are are functioning. So that was very, very new, because Wynn was one of the companies that did the inspection, and they were refusing to write such a letter. So that gave us a little bit of a hold, and until they understood exactly, they said nobody's ever asked us to write a letter like that before. And after we explained it, we got them to talk with the insurance company. They agreed to write that letter, just saying, yep, we've inspected this, everything is okay. So that's new. Anybody else has seen something like this happen?
So that's something I'm guessing is Travelers. That's something that is new from them. I haven't seen that specific thing from other carriers. What that is essentially a reason or a way for Travelers to limit what insurance they're taking. So every insurance company is trying to either walk out of the market, stop taking new business, or find ways to limit what they take. And that's Travelers' way. If they make things difficult on you, the more likely you're going to go somewhere else. And that, unfortunately, is their goal. They're absolutely trying to push you elsewhere. Or if you want to comply, then they feel more comfortable about taking the risk.
Ouch.
Okay. Somebody asked a question about earthquake.
Yes.
Okay, earthquake insurance. The state of California, roughly 10% of the 40 million people in California purchase earthquake insurance. Of my customers, I would say it's also about 10%. I personally don't believe in it. I always recommend to people that they spend $2,000 to $4,000 to retrofit their house. And today, in the old days, you could grab the yellow pages. Today, you can do it online. Get a retrofitting contractor. I get a couple of them come out and bid, putting in extra foundation bolts and shear walling, and forget buying earthquake insurance.
And the question on earthquake consensus was related to homeowner association. You have no control over that policy at that point. If the HOA buys the earthquake, the homeowner themselves in an HOA that has that, they don't get the option to buy insurance on their own. That HOA can only get a master policy that covers everyone. You can't get an individual policy that will cover the structure in an HOA, because you don't technically own the building, you own the air. And the HOA is responsible for ensuring that.
So, Paul and Sterling, I want to thank you very much for participating in this panel. And this is even better than I had expected, full of solutions and insights. Would you leave us with something positive or something that the real estate agents can do to protect the transaction?
So my advice would be call us, both of us, ahead of time. When you get a listing or when you have a potential buyer on something, we'll be happy to tell you, yes, we can insure it. And here's, quick ballpark what it's going to cost. And then if you want to give us information, then we can drill down and get a real quote. Again, we can still write business. It's just the amount of carriers, the options aren't there. But there are some newer companies coming out there. We just signed up with a company called Honeycomb, you never heard of. It's an Israeli company, but they're, from personal standpoint, they're only writing dwelling fire policies, 1 to 4 family dwellings, and they're writing apartment buildings and HOAs. And so they have a very limited market, and they're doing all their underwriting is artificial intelligence. So if it fits, they'll quote it. If it doesn't fit, they won't quote it. So whole different model.
I mean, just to try to say something positive. I mean, in a tough market, I know that it's stressful on, everyone here. Every side of the market is being affected by insurance, and I'm sure rates aren't helping your guys' causes either. But this is temporary. I mean, in reality, this is going to be with us for a while, but insurance has been around a long time, and it's gonna work itself out. And a lot of times, when I'm trying to walk this through with people and talk them off the ledge, depending on the situation, there's going to be markets that come in and there's going to be markets that come out. And this is just an extreme situation. And so I kind of tell people when we're looking at something that it's a placeholder. It's not ideal. It's a lot like, I'm sure it's like selling a loan. You're probably telling people right now they're going to refinance in a few years off of this 7%, 8% loan. And it's going to be kind of similar in the insurance. You're going to find that options are going to become available as the market starts to level out and this reaction to profitability goes away. So I would say, we have to have that conversation with people and tell them that, yes, this insurance does not look good. Yes, this is not ideal. And hopefully by this time next year, let's have a conversation and see what else is available. Because I don't think that people take that into account, that this is an extreme situation that we haven't dealt with before. I mean, the closest thing to this market is a proposition that was written in the 80s that kind of created a little bit of what we're dealing with right now with rates. Most people that have been this, and I have to imagine Paul is going to be the perfect example. Most people haven't seen anything like this, and he's been doing it for 40-something years.
Thank you, Sterling.
It's a blip. It's a point in time that we're going to look back and go, "Whew, that was rough." But a lot like the financial crisis, it's going to be a couple of years. We're going to rebound from it, and insurance is going to probably look a little different than it did, when we went into it. But it will be there.
Thank you, Sterling. Thank you, Paul. Really appreciate your
My pleasure.
wisdom here.
Sure.
Jean, you want to wrap it up?
Sure. So I just wanted to end up by saying thank you so much to, again, to Paul and Sterling for just your wisdom and experience. And the sky is not falling, which is great. And really to say thank you to Elsie. As she mentioned, she interviewed 5 insurance brokers, has taken a lot of time to prepare this. So I'm very happy. When Elsie was asking about questions, I was like, it's probably everybody's just soaking it in, and I'm sure the questions will come, and sure enough, they did. So really appreciate Elsie, our speakers, and really the rest of this group for all of your insights and questions, great questions as well.